present on the employee retention credit, and this is applicable for 2020 and 2021. So we're going to go through a bunch of slides, talk through potential ways to qualify, how you go about doing it, and then also potential on credits that you can get, and talk through maximums and how it all works. So just to give you a brief background, let's do it for Josh. Do you want to jump on and do yours, or he's not here? So Josh Terrell is a partner here at Larson Gross. He works on the construction practice along with myself, and he's headed up the employee retention credit area of the practice the last couple of years. As we get into it, you'll see that there's a significant amount of opportunity here, and so we've been really busy doing a lot of these over the last few years. So he's kind of the head guy on this. I've done a lot of them just from my client base, being construction, manufacturing. We have some restaurants, and so a lot of those folks were affected. And so have a lot of experience just talking through how we qualify and how we got the credit. So, but I can give you a little background about our firm. Currently have 5 offices. We have about 190 team members. We're on the west side up in Bellingham, Burlington, and Linden, and then also have offices in Wenatchee and Yakima, so serving both sides of the state. Focus more on the rural communities. We do better working with clients that are located in those areas and kind of share the same values as us. So yeah, I think we can kick this off. Josh, I did a little background on you and myself already, so I'm not sure if we can hear you.
He's trying, but we can't hear him.
Okay, so we can move to the next slide here. All right, Josh is going to go get some help from our IT department. So
okay.
All right, well, I will jump in and get this thing going. So we go to the next slide here, the employee retention credit. The biggest piece of this, and we'll spend the most amount of time, is actually on this slide, and how the employee retention credit works. And there's a few different qualifications we'll get into, but it really started when the pandemic hit, which is March 13th, 2020. And so there's 2 different periods. You have the 2020 period, and then you have the 2021 period, which goes from Q1 through Q3. And then potentially Q4, but only for businesses that were started after February 15th, 2020. And then there's also some other like revenue limitations as well. So if you were a startup company, you could potentially get 1 more quarter there as well. But the first piece of this to look at on the calendar would be, March 13th, everything hits. The governor of Washington issues some significant shutdown restrictions, specifically geared towards like construction and other industries towards the end of the month. And so for construction, you're looking at potentially like a 6-week window where you may have been able to work on some of your, job sites. You may have been able to be open for some of your work, but if things were shut down during that period and you were still paying employees, there's an opportunity there for you to be able to qualify. And then, if revenues took a big dip during any of those quarters, you also can run into a qualification period at that point too. So then when you jump into 2021, there's a lot more opportunity that comes out of that. So when we get into the details on this in the next few slides, 2020, the revenue reduction had to be pretty significant if you're going to get into that qualification of about 50% or more. Once you get into 2021, that revenue reduction, and you're always comparing back to 2019 on a quarter-by-quarter basis, that reduction only needs to be 20% in order to qualify you. And if you qualify for one of those quarters, you will automatically qualify for the following quarter as well. So that's just some time frame there. So there's a lot of opportunity, a lot of quarters. Sometimes you can qualify for a couple quarters. You may qualify for one quarter. It all really depends on facts and circumstances here. One example I'll give later on would be, dealing with if you have businesses that were still running, but you only had part of it and some of it was shut down. There's some good opportunity there as well. So move on to the next slide. All right, so this really gets into the details. So in 2020, we're talking about looking at, let's say, quarter 2 of 2020 and looking at the same quarter 2 2019, and did your revenues drop by 50% or more during that period of time? And so if that question is answered yes, then you would qualify. And then we would look at your qualifying wages, and you're able to take 50% of those qualifying wages as a credit. But then you also get limited on an annual basis on how much you get for that credit per employee. In 2021, it's increased to 70% of the total eligible wages, and that's based on a quarterly basis versus an annual basis in 2020. And again, we're looking at what quarters do you qualify. We're always looking at the quarter in 2021 or 2020 compared to the same quarter in 2019. And a lot of this came about late in 2020. So it was believed at the beginning that you could either take PPP funds or you could take employer retention credit. You couldn't do both. And as you see in that note down at the bottom, at the very end of 2020, the CARES Act allowed for you to be able to take 2020 and 2021 ERC, even if you took the PPP funds. And when we get into the calculation, that's where it gets a bit tricky, because if you have PPP funds, you cannot use the same qualifying expenses there also towards the employee retention credit. So we'll get into that later on with the overall calculation. Again, this is a table format, really helpful. So the question would be, the gross receipts, are they 50% or less the previous comparable quarter? So this is an example of what we talked about in the previous slides. And then, so there's 50% in 2020. Now, if you look at it, you only have to have a drop of 20% or more for 2021. And so that's huge. The other piece of this that changed, which is great for some of the larger employers, is that your employee, your large, if you're considered a small business, it was if you had 100 full-time equivalents, and that in itself is a more involved calculation than just did you have 100 people on payroll throughout the year. But then it goes up to 500 for 2021. So a lot more people were qualifying there. Partial shutdown period, that qualifies for both years. We can get into that later on. Credit rate is what we had talked about earlier. 50% of those wages for the whole year, 10,000. So if you do the math here, the max you can get per employee for 2020 is $5,000. Josh, we heard you there for a sec. And then the max you can get for 2021 is up to $7,000 per employee per quarter. And so that next piece down there, yes, you can claim ERC and PPP together. And what we had talked about earlier, you cannot use the same wages for both. So if you look at it, you want to make sure that you fully qualify for the PPP because that money is tax-free. And then the ERC would come next if you have available wages to qualify for the credit.
Next slide, or are we going to test Josh real quick?
Can you hear me?
There we go.
Justin's doing such a good job. I kind of wanted him to just keep rolling. So
we'll sub out here. We'll let Josh take it on the next slide here.
Okay, go for it. All right, so just getting into eligibility stuff. Some of this is kind of repeating what we've talked about previously, but let's flip to the next slide. So, just kind of from a high level, if we take a look at this thing, and again, repeating ourselves a little bit, but we really want to make sure that some of this stuff sinks in. The big misconception here, and I didn't hear, some of Justin's early stuff, is that you can't take ERC and PPP at the same time. Now, since about Christmas of 2020, they reversed that, and we now can, as long as we're not double dipping on those wages. And also just a reminder that the PPP used, just our total gross wages, whereas the ERC can use both our FICA wages and any health care that the company was paying on the employee's behalf, and in certain cases, healthcare that the employees were paying for themselves. So there's more that goes into these wages than with PPP. The full-time equivalent eligibility is also different than PPP, and I don't know, our demographic as far as the size of companies on this, on this call today, but there's a big difference between a quote unquote large employer and a small employer as far as what wages qualify for this credit. Again, repeating that previous slide, if we are less than 100 full-time equivalent employees in 2020, we can qualify a lot more wages than we can if we're over 100 employees. For 2021, that FTE number bumps up to 500, and I assume most of us, if not all of us on this call, would for sure be below that 500 FTE mark. And there's some nuances as far as how those FTEs are calculated as well, but just know that there's some big differences in how this credit works based off your size.
Josh, I'd say, just for an example, can you give like the one client you had that had a ton of part-time employees and how many FTEs they really had when you did the calculation?
Yeah. So, I mean, we've seen some seasonal, let's just say, agriculture type businesses that ramp up to, possibly 200 employees during harvest season. Outside of that, on average, let's say they might have 50 to 80 or something. And when you go through the FTE calculation, you see those numbers drop dramatically. And a lot of the times, they might be at 200 employees during peak season, but their average for the year is something closer to 80, and they qualify for a small employer exemption. So there's definitely cases where that happens. Another nuance to this relates to companies that possibly the owner or the owner's family owns other businesses. And we've seen this work for us, and we've seen this work against us. But when we go through the qualifications for this credit, again, that's, the hitting the decline in our gross receipts, or determining whether we were subject to a partial shutdown or not. We need to look at this from a standpoint of what we call a controlled group. So if I own a restaurant over here, and I also own 70% of a construction company over here, I control both of those entities, and we would look at this as a whole, basically. So when we calculate our total employees, when we calculate our decline in gross receipts, when we look at whether or not we were partially shut down, we look at it globally across all entities in our controlled group. And again, we've seen this help us and we've seen it hurt us. A situation where it might hurt us would be if we saw, a decline that meets the gross receipts decline over here in this entity, but another entity was thriving. We stick them together and neither one of them qualify because we're looking at them together. Where this could help us is if we had that same scenario where we have a restaurant that was partially shut down through June of 2021. And we also have this construction company over here that was only shut down for a small period of time. When we stick them together, that restaurant being shut down through June of 2021 can pull that construction company in, and both of those companies would qualify. So something to remember there is as we assess your company, if you have related entities, we need to take a look at those as well. So, and then the other piece, and we're going to go into this more in a second, so I'm not going to get too far into it. The gross receipts test is very black and white, right? We can quantify it. The numbers roll out and kind of speak for themselves. This full or partial shutdown piece is the one, where it's getting, a lot of attention and there's a lot of subjectivity. But, just a reminder on this, and we'll get more into it here soon. If you were essential, and you had, no decline, or shutdown or whatever, you could still qualify for this, depending on, how essential you were. There's nuances that I wouldn't just automatically say, hey, we were, Governor Inslee determined that we were essential during COVID, so we don't qualify for this. I would caution you to stop there without asking more questions on this. And also, simply the fact that that your business did well through COVID does not in and of itself disqualify you from this. We've certainly seen companies that actually had one of their best years ever during COVID for whatever reason. But they on paper were restricted due to these government orders placed on them, and we were able to take this credit for them, even though they had one of their most profitable years in the history of their company. So a caution to just not give up on this too soon.
Well, and I'll jump in a little bit on this, just if you don't mind, and we'll go to the next slide. But I would say both for small businesses and what is now considered small business, which is up to the 500, but also the nonprofits, because that's the reason we asked you to come today for this webinar, is because the chamber, we didn't think we were eligible as a nonprofit, but we were deemed essential during the shutdown. We still retained our employees. We had benefit packages for those employees during the entirety of the time. And what I really appreciated about your guys' process was you gave me a list of documents to provide you, and you were like, let's just see. And so that's why I really encourage those that are listening. There are so many mixed messages right now when it comes to the employment retention credit that you need to go to a trusted CPA or a firm that is specifically working on the ERC and let them run the numbers for you to let you know what you're eligible for and what you're not eligible for. So I just really appreciate you saying that last piece of don't just think you're not eligible. You gotta go through all the nuances that are included into this process. So
absolutely good comments, Amy. I mean, I from a nonprofit standpoint, I think we've seen, of the different groups of clients that we've seen that have qualified for this, nonprofits have been one of the most common ones. And the reason for that is oftentimes, nonprofits, a big revenue stream might be events that they have. And, we weren't able to do events at full capacity for sure for a long time. And so the inability for us to do those events is a big qualifying factor. Churches are another one where, churches weren't able to have, people in for a long time. And did they, pivot to remote in a lot of cases? Yeah, but it took some time. It wasn't the same. There was a lot of stuff in there that just, wasn't the same through that process. And so, yeah, for sure, nonprofits are a big one. And another thing I wanted to piggyback on there, Amy, as far as what you said with not giving up, and letting somebody calculate this, the gross receipts test that we've talked a little bit about, needing our revenue to decline by more than 50% in 2020 and more than 20% in 2021. That is based off of your tax basis of accounting. And so what we've seen in some cases is, a company has calculated their gross receipts and said, no, we're close, but we don't qualify. And they're running that calculation based off their internal books, which is on an accrual basis of accounting. Well, if you look at their tax return, they do their taxes on a cash basis. And, a cash basis revenue can swing a lot, compared to the accrual based on the timing of some of your collections, timing of some projects you had in the prior year or whatever it is. And so we've seen some pretty crazy success stories of clients that have recalculated or had us recalculate their gross receipts and on a cash basis, they qualify. So don't give up. I agree, Amy.
Maybe I'd piggyback off of reaching out to your CPA. I will say, Josh and I have seen this time and time again. Some of our clients get hit up by these boutique specialists, and they're charging a contingent percent fee, which is, 20-25% of the credit. Well, they're going to be really pushing the envelope on this. We've seen it multiple times where, they're not conservative at all. So I would caution people on those boutique firms, and rely more on your trusted advisor, your CPA, or somebody that's, you've worked with a lot in the past.
Agreed. So, here's just an example. And again, we'll kick out the slide deck after this and you'll have this, but just an example of just kind of a flow chart for 2021. And we have another one for 2020 of just kind of the thought process you can go through here. Clearly this thing is complex and there's lots of nuances to it and stuff like that. But as you start to self-assess your business or your organization, this is just kind of a flow chart that you could use to start to determine, whether or not, you get to a point. If you run into a spot and you're like, gosh, I don't know I don't know exactly, we're close on the 500 employees, or we're close on the 100 employees, or, I'm not sure if we were partially shut down or not, that's when you stop and ask your CPA, reach out to us, and we can kind of talk through some of these nuances, because it's complex. This is a simplified version of a self-assessment, and yeah, it's not clear as day. I know Justin touched base on this a little bit, but going back to the gross receipts test for 2021, again, we mentioned that your gross receipts would need to decline by greater than 20% in any quarter compared to 2019. And so we wanted to give some examples of this. What this would look like as you're self-assessing these. So if we were to look at the first quarter of 2021 to calculate the gross receipts test, we would first look at option 1 up there, which is taking a look at Q1 of 2021 gross receipts. That's our revenues, our event revenues, our sales, stuff of that nature, and compare that to Q1 of 2019. everything goes back to 2019, which is our last quote unquote normal year to compare as a baseline on this thing. So that is step one in this process of evaluating your gross receipts. There's also an alternative to that calculation for Q1, and we're able to look back one quarter and calculate that quarter. And if that quarter qualifies, then we can automatically qualify this quarter. That's confusing, but here's how it would work. If we are shooting for a 20% decline for 2021, but we look back at Q4 of 2020, which is our last quarter, and compare that to Q4 of 2019, and we see that there was a 20% decline that quarter, we can use that calculation to qualify the quarter that we're in now. So it's a 1 quarter look back. And so what the easiest way to explain this would be to say, if we can qualify 1 quarter, we automatically qualify the next. Mm-hmm. Okay. And so there's certain instances in there where we can get some extra quarters to qualify, and we didn't think they otherwise would.
There's a big, I've seen a ton of my clients qualify there, because if you think back to the end of 2020, a lot of customers had receivables that were really high. People were sitting on cash. So if you were a supplier, a subcontractor, and you're on the cash basis, like Josh was talking about earlier, that's where we saw it a lot, was that our clients weren't getting paid. Maybe they had a really good accrual quarter where they sold a lot, but they just didn't get cash. And so that's where that 2020, that Q4 qualify for Q1 of 2021. I've seen that a ton. Just a real life example of why you want to look at that.
Okay, let's keep going here. Can we go to the next slide, Amy? Thank you. Okay, so deeper dive. Let's go to the next one here. This is the single most subjective part of this, and the most misinformation comes out with this piece of it. And to be quite honest, the reason there's misinformation is because things aren't super clear in the regulations that they've kicked out on these things. And so they've kicked out what we call, IRS notices that try to explain some of this stuff. Built into those notices are examples of stuff that would qualify and stuff that wouldn't qualify. Obviously, every situation is so different that not everything fits into these few examples that they give in the regs. And so there's FAQs that have been kicked out. All this to say that this is a very, very subjective piece of this, and the one that is misconstrued the most. As Justin mentioned earlier, there's a lot of kind of boutique credit agencies that are coming out of the woodworks right now that are contacting everybody. Honestly, I mean, I'm sure you've gotten contacted on here. My wife coaches college basketball, is not self-employed, and has been contacted multiple times to take this credit that she has no part in taking. And so people are reaching out to everybody on this, and quite honestly, in many cases being very aggressive on this piece. What the regs say in general is that in order to qualify for this full or partial shutdown, you need to have been suspended, if you will, by a governmental authority. And so obviously, we can all put ourselves back in COVID and remember, whether or not we could stomach it for too long, but watching, Inslee, have his weekly or daily or monthly telecast laying out, what is open for business, I guess, that month or that week, and when stuff is going to start opening and whatnot. Those are a good example of government shutdowns that may or may not have impacted your company. And I really want to emphasize this whole governmental authority piece here, because there's certainly companies that, you know, the owner wanted to protect the employees. And so while, you know, governmental authorities didn't shut them down, they closed their doors for a lengthy period of time because they wanted to protect their employees and they didn't feel it was safe. That does not qualify for this because it was not from a governmental authority. It has to come from, you know, a federal level, a state level, a local level, something that's telling you that you can't operate your business in the same fashion you've done before. How does this get construed? Well, you know, I've sat through some of these calls where, you know, a boutique credit company is saying, you know, hey, you're a construction company. You know, did you have some additional OSHA requirements on job sites? Were we having to wash our hands? Were we having to mask up? Were we having to sanitize? Yes, we were. You know, but in our opinion and most opinion, that doesn't rise to the level of, you know, limiting your commerce, you know, and limiting your ability to do your business. It was a pain in the butt, but it wasn't limiting our ability to do, you know, to do our job. And so, you know, it's subjective in nature. But for the most part, you know, we are wanting to tie this back to some sort of governmental authority that was instructing us to modify the way we do business in some sort of significant manner. And we'll give some examples here in a second. Okay, next slide. You know, if you know, obviously, if everything remained open, you know, and we kept going, in our opinion, we weren't shut down by the government. So if we had to, you know, if we were open, I'll use Larson Gross as an example. Our firm, for a period of time, you know, we sent our employees home. They worked from home. They were able to do essentially their full job from home. When they came back, our employees were masked up, we were spaced out, we were sanitizing, we were doing that stuff, but we were still doing our jobs. I mean, we could substantially continue on. And so, you know, the fact that we remained open, we were able to continue going, we didn't qualify for this, or we don't feel we qualified for it. However, you know, if you had a business that, you know, let's say you run multiple things out of your business. So you may have had, you know, some essential components to your business, but some non-essential components to your business. You know, if those non-essential operations were you know, shut down and significant of any kind to your greater business, that could get you there, and likely does get you there. And again, you know, just because you are essential, you know, doesn't necessarily mean you weren't partially shut down. There could be some, you know, some other extenuating circumstances that we'll talk about here in a little bit. So I've mentioned the word nominal a few times. And so when we say, you know, more than a nominal piece of your business was partially shut down, the only guidance we've got on this from the IRS has been this 10% number. And what does that mean? Well, if let's say that we've got a company that, an example would be a company that roasts coffee beans, but also has a restaurant that they, you know, a coffee shop that they also, you know, serve out of. And so a large portion of their revenue comes from, the development, the manufacture, sale of those coffee beans, but the restaurant is also, a more than nominal portion of their business. What we would do there is we'd look back to 2019 and say, what percentage of our business was that coffee shop back in 2019? And if it was more than 10% of our gross receipts back then, and it's shut down, we can say that, more than a nominal portion of our business was shut down, and we are going to qualify the entire business, not just that segment of it. Another way to look at this would be hours of service. If let's say we've got a business that runs shift work, and in a 24-hour day, usually there's 3 8-hour shifts that employees are coming in and out and working throughout the day. If during COVID they were forced to shut down between shifts for 2 hours and to clean, sanitize, do all that stuff before they started the next shift, we're talking about 6 hours out of a 24-hour day, greater than 10% of the total hours that we weren't able to run our business. That would suck the whole thing in as well.
Josh, I think a classic example too, just we've seen it with so many of our restaurant clients, is how they were qualifying because in-person dining wasn't available. So just, if there's a lot of restaurants on this call, just consider that. Like if you had a drive-through or you were doing to-go orders, you couldn't have in-person dining, that's a qualifier. So think about things like if part of your business wasn't able to go, but you were still making revenue, like Josh said earlier, don't just discount yourself as not qualifying. You need to take a deeper look at that.
Is that something also, Justin, for restaurants that had the opportunities for outdoor patios to ensure some of that? Then those are some of those things that you're saying, think outside of the box of normal operation. And if you had to do something to accommodate the partial shutdown or the full shutdown, this may qualify you.
Yeah, I can give you an example. I'm the treasurer of our country club. For a number of rounds of golf for the year during COVID, just absolutely spiked because people wanted to go outside and golf. Membership went way up, but we also had a restaurant that makes up 10% or more of our total, revenues, but we couldn't do in-person dining. So we were able to qualify the country club through June of 2021 until in-person dining was allowed to start back up. So that's an example of how we pulled the whole company's operation, the country club's operations or company, if you want to think about it that way, and we're able to qualify the whole thing. And we had a lot of people employed because we needed more people taking care of the grounds and doing all sorts of other things, but we were able to qualify the whole operation.
Amy, just because you mentioned nonprofits earlier, and this is another place where nonprofits, we've done a lot of analysis with this, because a lot of the time with nonprofits, it's not like a retail outlet where there's one revenue stream. It might be 7 different revenue streams that on any given year our nonprofit has. So we might get some grant revenue. We might have a decent chunk of our revenue stream coming from events that we're part of. Memberships might be another piece of it. And so there's a lot of different prongs, a lot of the time, to revenue streams from nonprofits. But when we look at those, and again, we go back to 2019 and we take a look at what were our revenue streams in 2019. And, if we had 2 big events each year that made up 25% of our total revenue, and we couldn't have those, at least not in person. We modified it to do, the event online, but participation was way down. It wasn't the same. We weren't able to do what we wanted to do. But we got some big grants over here, or contributions came in, greater than they had in the past, because people got all this, money for stimulus and COVID stuff, and donations were up. So our revenues were flat, but we couldn't do our two big events. That's something that's likely going to qualify your nonprofit as well. So there's lots of examples like that. Okay, so some other examples of partial shutdowns, and the first one here I want to tread really lightly on, because it's this supply chain is one that I think when we talk about misinformation that's out there, I think this one is really, really murky at best as far as what does and does not qualify for a partial suspension due to supply chain issues. And so, I mean, if you're in any type of business that requires materials of any kind, that most likely during COVID, and you may still be up against this now, there's been supply chain issues. And, for whatever reason, I think there's a multitude of reasons why we've seen supply chain issues, but it started during COVID and in mid 2020, and we're still seeing the impacts of these supply chain issues now. And so the question is then is what rises to the level of the supply chain causing a partial shutdown? Well, it's our opinion, and again, you'll see some aggressive positions on this, to where if a boutique credit company saying, hey, if you could get your supplies 2 weeks after ordering it before COVID, during COVID it stretched out to 4 weeks or 6 weeks, you're partially shut down. That's a 2 to 4 week supply chain disruption, and you automatically are going to qualify until that comes back down to 2 weeks. That's not a position that we are taking here, and I think that is very, very aggressive. What does qualify in our minds as a supply chain disruption, or one that causes a partial suspension, is tracing it up to your supplier and saying, what caused this supply chain issue? Was there a governmental authority that shut your supplier down for a period of time that created this inability for you to get those supplies? Okay, now we're tracing this back to a governmental authority, as we look back at the verbiage on this, causing your supplier to be shut down. You weren't able to pivot to a different supplier that wasn't shut down. And that's, that chain of events, I guess, we can draw back to us and say, okay, our supplier was shut down due to COVID. We couldn't get our materials. Inadvertently or indirectly, we were shut down as well, and we are going to qualify for that. So I guess I caution you as you talk to others or whatever, to just jump to the conclusion that if we had some supply chain delays, that in and of itself just automatically qualifies for us. We haven't seen these audited yet, knock on wood, so we don't know what the outcome will be when they start auditing these, but I have to believe that that's going to be an area where you're going to have some significant documentation as far as why you're taking the position of a partial shutdown due to supply chain. Other common or easier stuff, or just facility closures, non-essential operations. We talked about that. Limited access to equipment. Some of this stuff is a lot more black and white than others, but again, it's worth looking into. It's worth talking through with your advisors.
And I was going to point that out again, Josh. This is definitely, when we start looking at the deep dive that we're doing right now, this is why if you're leaning to go towards the ERC, definitely do it with a trusted professional. These are things that you can evaluate, but if you really start doing it, it should be probably with a trusted professional going this far.
There's an estimate out there that there's $2 trillion of fraud that's gone into this. 2 trillion. So some of these firms are really pushing the envelope for stuff that you don't want to have to deal with under audit, because they'll likely won't be in business when the IRS is starting to take a look at these.
Well, and I appreciate that comment too. And so I just want to make sure that we're doing a time check. It's 12:47. We've given about an hour for this webinar. And so there are some questions that I know I have had with some conversations. So are we still on track, do you feel?
I honestly, I've got one more slide and it's going to take no time at all. And then we'll get right into questions.
Perfect. Just wanted to do a time check real quick.
Yeah, no, I think we're good.
Okay.
This last one, and this is really just a reminder that all of these tax credits and stimulus packages interact with each other, and we just need to be very careful that we're not double dipping. We talked about the PPP loan and making sure that we're not double dipping on those wages, but there is a game that's played in there that, you know, if we get a $500,000 PPP loan and during our covered period we had 800,000 of wages, there's 300,000 of wages that we can play around with and kind of shift around so that we optimize the most employee retention credit we can possibly get while sufficing our PPP loan as well. There's other tax credits that play into this as well. The research and development tax credit, that's one that we can't double dip with this on, so you got to be careful there. Work opportunity tax credit, certain things like that. So just something to be careful of there, but it's, you know, you were saying optimize. There's different ways to move these wages around to, you know, to maximize the most bang for your buck out of, you know, each dollar of wage, depending on which credit we can qualify it for. So something to remember there as well. So let's, Amy, do you want to kind of just run this portion of it?
I'm happy to do that. I'm going to actually stop sharing my screen. First and foremost, we do have 2 attendees, but this is being recorded. So hopefully those that watch this after today's webinar time frame, if you have any questions, you can reach out to the chamber. We will refer to Larson Gross if you would like us to get those questions answered. So starting off with my questions, and then I believe in this webinar, again, this is our first one, I think I can open the Q&A to the attendees. And so let me start with my questions, and then I'll open that up to the attendees that are with us. First and foremost, thank you so much for doing this today. I know my situation with the chamber, I was told not to go forward with ERC, and you just have to do a gut check. And so with my gut check, I was in on a meeting that Justin did a presentation in regards to the performances that your firm has done. And so I would have to say we were eligible, and we are so grateful for that eligibility, because it does make a difference when you're a business in Washington State that can get a little bit of credit, you know, so it goes a long way. So thank you so much for joining me today. One of the questions that have come up is, so you had the PPP, which Justin said was forgivable, right? But then you had the EIDL, which people got confused on. Then you had some grants that came in. And so like businesses that were taking advantage of small business grants, come to find out they had to pay taxes on it. It was one of those anomalies that CPAs weren't quite sure how it was going to run and what it really looked like. And so some professionals were saying, no, you're not going to be taxed on this. Yes, you're going to be taxed on this. So it was just that conundrum, I would say, during the COVID. So my first question, this is a tax credit to which then what happens when they are eligible and move forward with the process?
Yeah, so the way this is claimed, let's just start there. So how do we claim this tax credit? It's not a credit that we take on your income tax return. It's actually a credit that we claim on an amended Form 941, so a payroll tax return that we would go back, or whomever you have do it, would go back and amend your payroll tax returns to claim this credit. Once it's claimed, it's mailed off and it sits in IRS land for an undetermined amount of time. Amy, I can't remember how long it took for you to start getting checks back. Do you recall that?
I have yet to receive one. And we did ours in what, October? Wasn't it?
Yeah.
I think it was October.
I had a client just get one that we filed, I think, June of 2020. It just got paid.
So we tell people 6 months. We've seen some that have come through in 3 or 4 months, a lot of the time smaller dollar amounts. Others, as Justin just referenced, we've seen take over a year to get. And so, excuse me. So for a stimulus, it seems very strange that it takes 6+ months to start receiving these checks, but that's the process, is mailing off amended returns, ultimately receiving a notice that says, hey, we processed your amended returns, and keep an eye out in the next 2 to 3 weeks for your checks to start arriving. At that point, you've received the money, it's in your bank account. That is unrestricted funds. There's no restrictions as to what you can spend that on. But the one caveat, different than PPP, is that this money is taxable. Okay, and so we're still okay with that, right? We'll take $1 and pay back 25 cents if we have to get to this. But it's taxable, and technically it's taxable in the year that you are claiming the wages on. So for example, if we file a claim on Q2 of 2020 wages, then technically you would have to go back and amend your 2020 business tax return. And if that's a flow-through entity, so an S Corp or a partnership or something like that, you would also need to amend the owner's tax returns for that year. That's technically the correct presentation of this, how it should work in the eyes of the IRS. It's pretty black and white. There's no either or on that. We've seen some clients that have chosen to do it otherwise, basically saying the credit's not that big. We've got lots of returns that would need to get amended. We're just going to run it through in the year that we receive it. Fine, but that's not technically correct. You're supposed to go back and amend returns. And so just wanted to point that out.
I think that was my biggest one. The other thing is, I guess, more of a point of clarification. So currently, Justin and I had this conversation before the webinar. In Kittitas County, which we represent for our membership, some of those businesses that if they're thinking if they're eligible or not, but restaurants more than likely would fit in some of the criterias of eligibility. So if you're watching this and you're a restaurant, it's worth the opportunity to just see, right? And then we also talked a little bit about the seasonal workers. So our agricultural businesses may just want to take that opportunity to just check the eligibility and just make sure they do their due diligence. I think that's really important. And so having said that, with some of those that may be watching this, is there a deadline that we may want to express on this tax credit?
Yeah, really, really good question there, Amy, especially given the fact that we're now somehow in 2023. So yes, there is a statute coming up. And so I guess as a reminder, we claim these based off of, on a quarter by quarter basis. And the first quarter that we can go back and claim is Q2 of 2020. And most likely everyone, would have filed their Q2 2020 payroll tax return in July of 2020. Okay, so right after June. The statute is 3 years from the date that you file that 941 that we can go back and amend it. So what that would mean is that the first quarter of that we're able to file these for, which was Q2 of 2020, which is the most common one, that's when everything shut down. That statute of limitations runs out this July, basically, depending on when you filed that 941. So we're coming down to, less than 5 months left to get those filed for Q2 of 2020. Really good question.
Yes. I was confused by that. That's why I'm asking that question. It's because I work on deadlines, right? So it's always good to know that information. As we share this out, what is your guys' availability from a firm perspective? And I believe, do you not have offices? Yes, you're from an office over on the west side, but do you not have some closer offices that maybe would be interested in assisting those?
You want to take that, Justin?
Yeah. So we have offices in Yakima and Wenatchee. I'd say if anybody on this call has questions, Josh and I would be the two main points of contact. A lot of this we can handle virtually. We can send out a request of items we want to look at. We can scope it. We're going to charge anything to scope it or answer a couple of questions. And if we think that there's some opportunity at that point, we would kind of talk it through, give an estimate on how much time we think it's going to cost. And we can process a lot of this remotely. I mean, we can meet in those, we have people in those offices that can meet to go over it, but I'd say to start out with, contacting one of us would be the best option right now.
Well, that's how I did it. And I did it remotely. You just gave me a great list and I went to my bookkeeper and gave her the same list. And so you had a secure link that we uploaded everything. So I thought it was a very well done process. So again, thank you for assisting us on that. Well, we did a time check at a little bit at 12:45. It's now 1 full hour from the time that we were talking, and it looks like our 2 attendees are getting ready to sign off. And so I'm going to just finish with some closing remarks, if that's okay. So the Chamber is doing On Point conversations. It's called On Point with Kittitas County Chamber. And these are webinars that hopefully we take a topic and we get to the bottom of it and then come back out and give you some resources that you can use in your businesses. So again, I want to thank Josh and Justin from Larson Gross talking to us today about the employee retention credit. Thank you so much.